Dr. O, lots of good stuff in your column this week, Everyday Economics, which runs every Monday across the Center Square Newswire. Appreciate you joining me. Let's jump in and talk specifically about the Fed action from last week. Why don't you recap real quick, the Fed decision to do a 0.25 or a 25 basis points, 0.25% cut. Let's start there.
What Powell called it risk management, right? A risk management cut. The labor market had been slowing, but the fact that basically labor supply has also come down means the unemployment rate may not be rising as much and as fast as people anticipated. And so and then you look at initial and continuing claims, they are actually moving lower. And wage growth remains firm, right? Well above.
Can I stop you there with those two? I mean, that's a lot of information.
Yeah.
Is that surprising to you? I mean,
yes, it is. Actually, it is. It is. We had, you have hiring at a decade low. You have no one's hiring, right? I shouldn't say no one, but you know what I mean.
It's slow.
And so you expect the unemployment rate to start ticking up, right? The labor market to loosen further. But basically the labor supply has been declining. And a lot of people, right, are thinking, hey, potentially this has to do with the fact that we have, we have all these deportations. We have, right, the whole immigration restrictions. We have, right. I don't know. I haven't looked at the numbers. All I know is that labor supply has been declining, and that's going to kind of, keep the labor market somewhat tighter, right? It's going to prevent, or at the very least, it's going to prevent further loosening of the labor market. And so wage growth, right? Remember, a function of supply and demand remains, kind of higher than it was before the pandemic still, right? Even with the big decline in hiring, we know the labor market numbers don't look very good, but because labor supply has been declining, it doesn't take a lot to, keep the, labor market, to keep the unemployment rate from rising. So I think that's the first thing. The second thing is, would a 50 basis point cut have been better is the real question, right? And if you think that, that basically the unemployment, the labor market is not as bad as people make it seem to be, because of course of that decline in labor supply, right? The fact that you're not going to get a big increase in the unemployment rate. And you also add to that the fact that inflation is still on the uptick, right? Been rising since March, April. Basically since the announcement of the tariffs, right? Whether they were put in place right away or not. Since the announcement of the tariffs, goods inflation has been on the uptick. And, you look at PCE inflation, core inflation at 2.9, PCE at 2.6% on a year over year basis. That's been on a rise, right? And so you have inflation moving in the wrong direction. You have a labor market that is not likely to soften much more because of the decline in labor supply, right? Not likely to loosen more. The unemployment rate not likely to increase all that much, more. The latest data showing initial and continuing claims actually moving lower, right? And so the big question is why 50 basis points, right? It doesn't make a lot of sense to cut fast. I think a prudent, more gradual approach, like the one the Fed chair suggested, seems to make more sense. Now, you also have the fact that essentially markets could, you could start to shift inflation expectations. If you have inflation at 2.6% and rising, and you have a Fed cutting in that environment, traders are going to start to think the Fed's not that serious about bringing inflation under control. And so that actually might have the counterproductive effect of causing yields to increase, which of course, right, if treasury yields are on the rise, everybody else suffers, right? Because your borrowing costs go up. So, So it really counterproductive to what the administration had been trying to accomplish. Right? Remember, the administration is trying to get lower yields for Americans. But if you cut too fast and you basically cause financial conditions to loosen and cause the shift in expectations, you could actually cause, long-term yields could actually start to increase instead of decrease. And so that's what we're seeing. We saw it last year when the Fed cut, right? Treasury yields increased 100 basis points after the Fed cut in September of last year. Treasury yields actually responded by rising this time around again. Hopefully not that as much as we saw last year, but moving up again, right? So the Fed has to be very careful, has to navigate this, right? Has to make sure that, people understand it's very serious about bringing inflation under control. And that's why I think cutting, going slow and gradual, and that gradual cut is probably the best way to go. The cost of fast is too high.
Well, so Stephen Miran's is going to speak today. And, again, we're recording this on Monday, September 22nd. A couple of things that he said in his CNBC interview, which I believe it was Friday. He was talking about, about the effects on that deportation will have on shelter costs, that the competition for shelter has led to higher shelter prices. But he said, and this is, so I just a data point, I wanted to share, but I think what he's going to talk about today and what he's going to try to map out, and these are his words, paraphrasing. Okay. That there's been with regard to tariffs, no material impact from tariffs versus non-tariffed goods. From any plans on presenting, apparently, for those of us who don't watch the Federal Reserve so closely, that the Fed governors typically do maybe one-pager briefs. He said that he's going to be doing something much more extrapolated that he's going to be releasing today, and then he's going to be speaking about. Do you have any insights on what's coming?
I'm looking forward to it. No one really knows what's going on. This is a new Fed governor. He was appointed for a reason. I think ultimately, he's a big supporter of the administration. The Fed continues to make the claim that it is not influenced by any administration, and that it will remain independent. I think that's important. And so I'm looking forward to hear the case, right, for a 50 basis point rate cut. Look, I'll be honest with you. I have been in the camp of cutting. I've been in the camp of cutting because the labor market was deteriorating very rapidly. But the latest data doesn't tell us. That tells us basically that we may not get further deterioration in the labor market, right? And that we may have landed here for a while. And so I have, ultimately, you have to change your mind when the data points in the opposite direction, right? If your theory is, one thing, and then data shows up and basically contradicts what you had in mind, you essentially have to learn to change your mind very quickly and to continue to take the data as it comes in and learn, right? And learn from it. And I can tell you that you talked to me maybe 2-3 weeks ago, and it was, hey, we need cuts because the labor market is deteriorating very fast. And now I'm looking at this and I'm thinking, well, maybe we need to go about it very slowly because actually the labor market is no longer deteriorating very fast. Right. And so just take the data as it comes and adjust. I think that's the right way to do it, as opposed to being very stubborn and sticking to one way and only and not taking all of the data in before making before making your decision. I hope to see, we're going to see what the new Fed governor has to say about that vote and how he justifies the 50 basis points. There's a fear that inflation expectations could become de-anchored. Essentially, if people don't believe in the Fed's ability or willingness to fight inflation, you could see with a labor market that's no longer deteriorating, you could see this, wage, you could see the price increases for sure. We're seeing them already. We could see the wage increases, to go along with those price increases. And then all bets are off. Whether tariffs are pushing inflation higher or not, well, look, we could argue about it. Maybe he'll provide some evidence that that's not happening, but that's not even the point. It doesn't really matter. What really matters is that inflation is still at 2.6% and rising, and core is at 2.9 and rising. That's what matters. And so whether you tell me it's tariffs or something else, we better figure it out very soon. But ultimately, inflation's moving in the wrong direction. The trend is not your friend. I think Apollo's chief economist wrote a piece today basically highlighting the trend is not our friend. Inflation is actually moving in the wrong direction. I think we talked about this before. The prevailing theory is that as prices increase, well, people will pull back because it will kind of squeeze their budgets. And so household spending will drop. We're going to get that in the PCE on Friday. We're going to see personal consumption expenditures. Are people actually pulling back? Right? So far they had been. The savings rate had increased and then it decreased for 2 consecutive months. Right. So again, the data was going in a way to suggest that we needed cuts and we needed cuts rapidly. And now the data is shifting again in a way that suggests that perhaps we need to go at it slowly and be very careful. And I think Powell's got this. I think Powell's got the right move here and even the right language. It's a risk management cut as opposed to a absolutely needed, desperately needed rate cut. And so, yeah, that's my assessment of the whole thing. I'm not sure. I look forward to the new Fed governor's assessment. And hopefully he'll convince me, and others that we need faster descent to the terminal rate.
Yeah, I appreciate your thoughts as always. Stephen Miran speaking today. I'm sure that'll be readily available on all the talk shows and certainly you can watch it, on YouTube. Let's call it good right there and we'll move on. We got a couple more episodes that we're going to record today. And you can hear a lot more from Orphe then. For Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics wherever you get your podcasts. Make sure you listen to us each week on the Center Square Radio Hour.